Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, our instinct to get the maximum from every penny spent is quite visible when it comes to buying car insurance, because if one does not make a claim, one does not get any value for the premium paid. At least that's the way we think. But making a claim every time your car gets hit may not be the most prudent course of action. In today's show, our Policy Bazaar expert and director Anjula Dheer will throw light on the two simple aspects that people often overlook and repent later. Now, the consequences of making a small claim, and then in the second half of the show, Angela will delve into the must-have add-on covers for your vehicle. Welcome, Angela. Now, tell me, why shouldn't one look at filing a claim every time we have a small accident rather than a big one? A lot of people say, oh, it's a small accident, but I must file my claim.
Arjun, instinctively what comes to mind is that you should not be penny wise and pound foolish. So at times,
that's the key, penny wise and pound foolish. Okay.
Absolutely. At times we tend to think, like you rightly said, that if I don't make a claim, my money is going waste because I'm paying that premium. But what one fails to realize is that if you make a small claim at this point of time, you need to weigh the pros and cons of making a small claim and what would be the long-term impact. So basically, in every car insurance, you have something called the NCB, which is called the no claim bonus. To explain it further, no claim bonus is it's something which the insurance companies gives the policy holder as a reward for making no claim in the previous years. So how it works is, in the first year, because there is no record of any claim, so there is zero no claim bonus. And so on the first renewal, you get 20% of your premium as 20% deduction of your premium as a no claim bonus. On your second renewal, you get 25%, third renewal a 35%, fourth renewal a 45%, and your fifth renewal going maximum up to 50% no claim bonus. So if you make a small claim, you will not be entitled to the no claim bonus. And once, supposing in your third year you made a small claim, so it will, instead of getting on the subsequent renewal, instead of getting a 45% no claim bonus, you will start with a 20% no claim bonus. So that's how, it is not prudent to every time make a small claim.
So one has to do the pros and the cons and say, all right, if I'm going to get 3,000 back from the insurer and I'm going to lose 5,000 in the discount that I get when I renew my policy. So that's the kind of calculation we need to do. But can you go into the details of how that calculation is actually done?
Absolutely. When you are making a claim, you need to keep in mind what is the no claim bonus which you will forego in the subsequent years. Second thing is that for every claim that you make from an insurance company, there is a variable deductible which has to be paid by the policy holder before the company pays the claim. Basically, for sub 1500 cc cars, it's 1,000 rupees, and for cars above 1500 cc, it's 2,000 is a deductible. Plus, if you just have a comprehensive cover, there is a depreciation cost as well. So you need to keep all these three things in mind when you are making, when you have to, go for a claim which is small in amount. To explain, supposingly you are paying.
So that's apart from the no claim bonus. That's what you're saying.
That is apart from no claim
Precisely. Bonus. So what you lose out on are those aspects that you're talking about right now.
Absolutely. Supposing you have a normal comprehensive policy, you have a claim of an amount of 10,000, right? So if you have a claim of an amount of 10,000, first of all, you have your deductible, which is 1,000 rupees, which you would pay on your own. You have a 3-year-old car. So the cost of, the various parts would be deducted for depreciation would be another 3,000 to 4,000 rupees. So which makes it 5,000 plus your no claim bonus, so which you would forego in the subsequent year. So what the insurance company is actually paying is just 4,000 to 5,000 rupees, and what you forego is more than that. So you need to weigh that, calculate that before you make a small claim.
Right. So now let's talk about the second part of this show, which are add-ons. Now, how important are add-ons? Do you think it's compulsory to buy add-ons as far as motor insurance is concerned, or should we not really look at them? What are the advantages?
So, okay, explaining what are the basic policies. First of all, you have a third-party policy, which basically takes care of if there is a damage to the third party person or property. Then you have the comprehensive policy, which takes into account the damage to self or car or car, or if there is a theft or there is an accident. On top of it, there could be add-on covers. Supposing if there is, there could be add-on covers like a depreciation cover. So in case for expensive cars or even otherwise, if you have to go for a claim or if you have to go for a repair and you do not have a zero depreciation cover, so you have to shell out a lot from your pocket because there is a deductible because of the depreciation of the vehicle, depreciation of the various parts. Second add-on cover which you should look at is a road assistance. What if you're just stranded? There is, you know, you have a flat tire, the battery has, you know, the battery is not functioning, so you have no fuel. So in those cases, a roadside assistance cover is a must, and people living in all cities should opt for it because you never know when you could have that eventuality. Then there is an engine protector cover, which again is important because, you know, there could be damage to the engine because of accident, water ingression or oil leakage, and in that case the cost would be very high. So what you have to actually shell out as premium is not much, but the benefits are there in case there is a requirement to make a claim.
So, and how are these add-ons priced? What is the kind of range that one would end up paying for, say, you know, the examples that you took for the engine protector or for roadside assistance? I mean, just a ballpark kind of a figure.
See, basically, Arjun, again, these are not very expensive considering the fact that your car is very expensive. For a roadside assistance, it could depend from 250 rupees to 750 rupees, 1000 rupees. If you look at your zero depreciation cover, it again would range from...
Right, Anshula, what about the costs? Is it expensive to take add-on covers?
Arjun, the costs are typically calculated on the IDV, which is the insured declared value of the car. And considering the fact that their car is already expensive, the cost of this is not much. Typically for an engine protector, it's about 0.2 to 0.3% of your IDV. If you look at a zero depreciation cover, it ranges from 0.8% to 1.4% of the IDV depending on the age of the car. Road assistance is somewhere between 250 to 750 to 1000 rupees, and if you if you look at a no claim bonus protector, again it's ranging from 0.2 to 0.25% of your IDV. So one should, when one is looking at an insurance cover for the car, don't look at a cover which is least in cost.
So what you're saying is it's a small price to pay. You know, and if you don't, and if there is a situation, you might end up paying a lot more. So let's now talk about, this leads us to the next question, which is about luxury cars. I mean, these are very expensive cars. Do they have different add-on covers?
Luxury cars, typically they have the same add-on covers. In addition, you could probably take an engine and an electronic circuit protector, because in a luxury car, the engine repair could cost anywhere between your 5 lakhs to 10 lakhs, so 10 lakh rupees. So in addition to all the covers like we mentioned earlier, in terms of your engine protector, your roadside assistance, you should take an engine and an electronic circuit protector, which is again, you know, comes in at a nominal premium somewhere around 5,000–6,000 addition to what you're normally paying, but it could be beneficial if you have to make a claim.
So what about costs there? Let me ask you the same question there. For a luxury car owner, does it make sense to buy add-on covers?
Absolutely. You should always look at...
The stakes are higher there.
Because the stakes are higher, and it makes more sense in going in for a luxury car, add-on covers in luxury car, especially even your zero depreciation cover, because, you know, the costs of the various parts are very high, and the cover, you know, these add-on covers, if you have to make a claim, will come in handy.
Right. So at the start of the show, we talked about making claims. Now, you know, one thing I wanted to ask you was that what are the scenarios under which we need to make those claims? You know, whether it's a small claim, big claim, is it based on your car? It's based on how old it is? You know, try and give our viewers a sense of a tangible idea of how they should go about it.
Good question, Arjun. So let's look at basic common scenarios. Supposedly you've hit somebody's car. Again, if you've hit somebody's car and the damage is not much, then you should not go in for a claim, because, you know, there's a lot of paperwork, reporting, etc. involved. Plus, you would have to forego, like we earlier talked about, your no claim bonus, etc. So it's better settling in on your own. Second scenario is that if the claim is less than 15,000 rupees. Again, if the claim is less than 15,000 rupees, you should look at the deductible which you will have to pay. If it's a normal comprehensive cover, there would be a depreciation cost which would be involved. Plus, you would be foregoing your future no claim bonus. So if the claim is less than 15,000, again weigh the pros and cons before you go ahead for it. Third scenario could be that when you have an old car and you are planning to sell it off. In that case, not many people know of it, that if you are selling the old car, you could basically take a no claim bonus certificate from the insurance company, which you could use for when you buy the new car, which would be more beneficial rather than making a claim. In the fourth scenario, which is again common, if you've already made a claim during the year, basically you can make a claim up to the IDV, which is the insured declared value of the car, in a zero dep cover. If you've taken an add-on of a zero depreciation cover, you can at maximum make 2 claims in the year, and after that your policy becomes a comprehensive policy. And in a normal comprehensive policy, you can take as many claims, but again up to the IDV of the car.
Apart from NCB claims, what are the other implications for making a smaller claim?
If you make repeated claims, it adds up to your claim history. The insurance company can hike up your premium when it comes in for renewal, because you are making frequent claims, so it could hike up your premium. You could also be denied a renewal, because if you are making frequent claims, you could also be denied a renewal. And of course, you would forego with your NCB, like you earlier mentioned, and it comes down in your claim history. So frequent claims would mean that you are not taking adequate care of when you drive.
How you drive, what
Absolutely.
you do with your car.
What you do with your car.
Right. That's all that we have in this section. We're going to be taking viewers' questions, and we're taking your questions. We've got Sumendra, who's 59 years old, and he asks, is it wise to buy a term plan after 55? And he says that he doesn't feel it's cost effective. Please advise. Angela.
Sir, I agree. After 55, it is not exactly cost effective to go in for a term plan. You would be paying about 35,000 premium for 1 crore sum assured. Basically, you need to take into account whether you have adequate savings or not, and about your dependents, and if there are any liabilities. If you have adequate savings, then you need not. But if you think you do not and you have liabilities, then you should probably consider taking a term plan at this age.
Right, we've got Shabir, who's 35 years old. He says, I want to build a corpus for my daughter's higher education. I have already invested in a traditional child insurance plan, and now I'm contemplating between a ULIP and a mutual fund. How do I choose between the two? Angela.
So basically, it's a good decision to, plan in advance for your daughter's wedding. You could look at both the routes, whether it's a ULIP or a mutual fund. Both of them invest in equity, and the higher the risk, the higher the return is. You should basically go for mutual funds if you think you are a person who can do it yourself. If you know what to invest, where to invest, when to invest, you could go in for mutual funds. But if you are not too sure, then you could go in for ULIPs. ULIPs basically have a 5-year lock-in period. You need to pay premium for minimum 5 years, and if you withdraw before that, then there are surrender charges and the costs are higher, and you get higher returns as you near the maturity of the term of the ULIP plan. In a mutual fund, you can get out at any point of time, but in both of them, since it invests in equity, the returns are higher. In ULIPs now, you even have ULIP plans which are debt ULIP plans. You could consider that option as well. But for your daughter's wedding, you should look at equity ULIP plans. There is a switch option also available in ULIP. You can switch between various funds.
What about the insurance factor?
In the difference, yes, Arjun, the difference is that in a ULIP plan, you would be paying some part of the premium as cost towards the insurance factor, but that will give you additional insurance as well, which will not be there in a mutual fund plan.
Right, we've got Anupriya, she's 37 years old, and she asks, between individual health plans and the family floater plan, which is a better one for senior citizens? In fact, she says very senior citizens.
Okay, Anupriya, very good question. See, basically when you're wanting to buy a senior citizen plan and you want to choose between a normal plan or a floater plan, two things which you need to consider is what is the age difference between the two partners, or what is the age difference between the members. Second thing is the medical history of the members. So if the age difference is very high, then the premium for a family floater plan is calculated on the basis of the age of on the higher age. So the premium becomes higher. So if there is a difference of more than 3 to 4 years, then you should not go for a family floater plan. It should be an individual plan. The second thing which you need to look at is if all the members are healthy. If one of the members has some ailment, then there is a probability that either the policy can be denied, or there could be a high loading factor which could again which would have an impact on the premium for the entire policy. So keeping these two factors in mind, you should decide whether it should be a single plan or it should be a family floater plan.
So we've got Saurabh, and he says, I have an active medical insurance plan and I want to know if it makes sense for me to enhance it with critical illness plan, and he wants to know which is a better plan on this front.
Saurabh, you haven't mentioned, basically what is the basic cover. So you basically need to make sure that you have a basic cover of 5 lakhs at least, and on top of it, you can look at enhancing your sum insured by taking super top-up plans, which could be L&T, which could be Apollo Munich or Religare super top-up plans. And on top of it, you could look at some critical illness riders or specific plans as well, like HDFC Cancer Care or critical illness riders with any of the plans which you choose.
Right, we've got Manojit, and Manojit asks, is it true that you cannot buy a standalone cancer insurance plan if someone in your family has had cancer below the age of 60 years? If so, then what are the available options for such individuals? Also, is it true that you cannot buy this product if you have a history of smoking?
No, Manojit, not exactly true. You can buy a standalone, cancer plan, even if there is a history in the family. It will typically depend on the insurer whether they give it or not. Typically, you can get the plan. And when you talked about the smoker, you may not be, the plan may not be declined, but there could be a higher loading, or there could be pre-existing conditions which could be, or exclusions which could be levied.
Thanks, Angela. That's all the time that we have on this show. But last week we asked you a question: up to what extent is FDI in insurance allowed by the government of India? And the correct answer is 49%. And the winner is Survi Bhatia. And this week's question is, what does IDV in motor insurance stand for? Now you can send in your entries to queries@policybazaar.com. Thanks a lot for joining us on this show, and we'll see you with another show of Policy Bazaar. Goodbye.